Imagine you're 25 years old and you're buying a house today and you're still paying that same home off when you're 75. That is the idea behind Trump's proposed 50-year mortgage that has recently come out the past week or two. And some people are saying it could make housing more affordable, others are saying it could trap you into a lifetime of debt. And today we're breaking down exactly how it works, who it helps, who it hurts, and why the second part of this plan, which is called portable mortgages, might actually even be more controversial. So before we jump into this video, would you take a 50-year mortgage if it meant cutting your payment by a few $100s? I'm very curious to hear where people stand on this because I know exactly where I do, but let's just jump right into it. So what even is a 50-year mortgage? It is exactly what you think it is. Right now, when you go to buy a home, you can either have a 15 or a 30-year mortgage. And so a 50-year mortgage would mean that your home loan is stretched out over 50 years instead of 30. The main reason Trump is proposing this is because your monthly payment would then be smaller, which helps people then qualify for a more expensive home. Because how it works when you go to buy a house is that a mortgage broker will basically look at your debt to income ratio, and they're comparing the total monthly debt payments to your gross monthly income. And so if that percentage exceeds a certain amount, then they are not going to give you the loan for a house. So imagine that somebody makes let's say $80,000 a year, their debt to income ratio would probably be too high to go buy $1 million home, even if they put 20% down, just because that monthly payment would be super high, assuming like a 6 or 7% interest rate. And so the mortgage broker does have to calculate your debt to income. And if your monthly payment is lower, that means it is a lower percentage of your gross monthly income. So then you could qualify for a more expensive house. So your monthly payment drops, but the total interest that you pay over the course of the loan would completely skyrocket. I'll talk about a couple of examples here. But before I do that, the main reason Trump is proposing this is so that it is a lot easier for people that are like Gen Z or millennials to buy their first house. Because as I've talked about multiple times on this channel, the housing market right now is just cooked. Even the rental market is, skyrocketed while wages have been pretty stagnant over the past 20 years or so. So let's actually jump into an example here that I saw on Yahoo Finance. So let's imagine that somebody is a buyer of a $415,000 home, which is around the median price in the US. If they put 20% down and receive today's average 30-year mortgage rate of 6.2% over 30 years, then they would pay $2,038 a month in interest and principal. So that is their monthly payment. And over the course of 3 decades, that works out to about $734,000 total, with $402,000 of that going towards interest. So that is the 30-year mortgage scenario, but let's imagine the 50-year one. What does that actually look like? So we're assuming all the same things here. $415,000 home, 20% down, 6.2% interest rate, except it's going to be a 50-year term instead of 30. Well, then in the 50-year scenario, their monthly payment would fall to $1,802 a month, but their total payments would rise to $1.08 million, with $749,000 going towards interest. So before in the 30-year mortgage, you were paying barely over $400,000 in interest, whereas in the 50-year mortgage, you'd be paying $750,000 towards interest. So it is almost doubled in regards to the total interest that you're paying. And the thing that's crazy about this example is we're assuming the same interest rate, but in reality, if a 50-year mortgage was created, the interest rate would be higher than the 30-year mortgage. And the reason that it's higher is to account for the risk that comes with a longer time horizon. And we can even see this now. If you type in 800 credit score, 30-year mortgage rate, what does that look like? You can see that a 15-year mortgage is about 5.5 to 5.6%, whereas a 30-year mortgage would be more like 6.1 to 6.25%. So it's about a 0.5% higher in regards to your interest rate. And so a 50-year mortgage, I would assume, would also be around a 0.5% higher. And so your monthly payment wouldn't actually be about $200 lower. It would be even higher. And the interest you're paying, that $749,000, that number realistically would be even higher. And we can even look at another scenario here from this ABC article that I saw, where basically you're looking at a $300,000 home with a 5% interest rate and a $5,000 down payment. Now, for somebody with a 15-year mortgage, your monthly payment would be $2,254, and your total interest paid over that 15 years would be $105,000. But with the exact same scenario, exact same down payment and interest rate, for a 30-year mortgage, you would be paying $1,530 for your monthly payment, but your total interest would go up to $250,000. And then finally, if we do the 50-year mortgage, your monthly payment would be $1,294, but your total interest paid would be $476,000. So obviously having that lower monthly payment would be nice, but paying that much amount in interest, and also just the concept of, let's say you bought a home at age 30, finally paying off the home at age 80 sounds absolutely horrible to me. I'm honestly really against this, and I've even heard that they've tried to do 40-year mortgages before and it's gotten completely shot down. So it seems like this 50-year mortgage concept is not something that will stick around for the long run. But if we break down who actually gains the most from a 50-year mortgage, let's just start out with this. The banks do, because they're getting so much more in interest. Instead of getting 400 something thousand, they could be getting 700,000. They're almost doubling the amount of interest that they're collecting. The other people that I would say benefit from it are buyers that are priced out of the current market at current rates, because the lower monthly payment would make it easier for you to qualify. But again, yes, yes, it's easier to qualify, but you're paying way more in interest over a 50-year period. And also the point I just made, do you really want to wait 50 years before you own a home? As well as the fact it's going to take you longer to build equity in the house. So who else gains from the 50-year mortgage? The banks definitely do. They're the biggest winners here. And you could make the case that buyers that are priced out of the current market, sure, they can qualify. But again, if the interest rate's a little bit higher, the monthly payment wouldn't even be that much lower in a lot of scenarios. But also if you're a first-time home buyer with low savings, that could help too. And so a couple people gain, but I want to make it very clear here, the main people that gain here are the banks and the lenders. That is the biggest winner in the 50-year mortgage scenario. And so who gets hurt by the 50-year mortgage is anybody who is planning to stay long-term, because if you're paying off that 50-year mortgage, you are paying so much money in interest, no matter what scenario you look at. Whether you're buying a $300,000 home or $500,000 or an $800,000 home, it does not matter. The 50-year mortgage interest is just ridiculous. Another type of person that gets hurt, and I talked about this a second ago, is people who want to build equity quickly. Because it would take you 50 years to fully own your home, it's going to take 50 years to fully pay it off, which means you're not going to have 100% equity until you hit year 50. So that's another factor. And then also people that are older home buyers, they could get pretty hurt by this, because if you're buying a home when you're 60 or 70, the loan's going to outlive your years. Like the loan's going to outlive you. So then how does that work once you think about that? And so here is a third example of the math. Let's pretend that you're buying a $400,000 home, 6.5% interest. We're going to assume 20% down on a 30-year mortgage. That monthly payment is $2,528 a month. On a 50-year payment, it is $2,278. So you are saving $250 per month. That is the difference there. So you're saving $250 a month, but the total interest you pay on the 30-year mortgage is $511,000 versus the 50-year is $962,000. It is almost double. So no matter what example I give you, the point is very clear here. You are paying a shit ton more money in interest. And another factor that I think some people haven't considered is that a 50-year mortgage could actually increase home prices, because if more people are qualifying for homes, that would mean that there are more buyers that can now get homes. And more buyers with the same amount of supply means that we will see price inflation. And this is just basic supply and demand here. Like if they're not building homes quickly enough and supply is not growing at the same rate that demand is growing, then if demand exceeds supply, then prices go up. It's just basic math there. That's a little microeconomics for you guys, but it's also very basic logic, so anybody can pick that up, I feel like. So sure, affordability could improve short term, but it could worsen long term, because you have a bunch of people that are qualifying for homes, you have more buyers, but you have the same supply, housing prices go up, so then you're just back at square one, and now housing is even less affordable. So one question you may ask yourself is, could this actually help Gen Z? Could this help millennials or just first-time home buyers? I personally think no. I mean, the pros here is, yes, you get smaller payments, it is easier to buy sooner, and there's a lower barrier to entry, but the cons here I feel like definitely outweigh the pros. One of them is that you are trapped in a 50-year debt cycle. That sounds horrible. You also build equity a lot slower, and you are paying far more money in interest over your lifetime of the loan. So before we jump into portable mortgages, the summary here of the 50-year mortgage is, yes, it helps cash flow, but it hurts long-term wealth. And these loans aren't bad, but they're definitely not for everyone. I really hope that this does not get passed, because I do think it is a pretty horrible idea. Don't get me wrong, I definitely want housing to be more affordable for people, but I do not think that this is the solution for that. And this is not even me taking a stance on Trump at all. This is just in general, the 50-year mortgage concept just does not seem like it makes any sense, and it does not check out. So that is the 50-year mortgage, but let's talk about the portable mortgages. What exactly does this even mean? So a portable mortgage is a mortgage that you transfer from your old house to your new house. And the reason that this is getting proposed right now is because there are so many people that do not want to move and go buy a new home because they don't want their interest rate to go up. They might have bought a house back in 2020 or 2021 and they had an interest rate of, let's say, 2.8% or 3% or 4%. But most mortgages nowadays are 6 to 7%. And so that's the main reason a lot of people don't want to move, is because they don't want to go from a 3% interest rate to a 7 or 6%, because it's just a lot higher that you're paying for interest there. And so with a portable mortgage, you'd be able to keep the interest rate the same, the loan term would stay the same, and the new loan amount would depend on how much the new house costs as well as how much equity you had in the previous home. And I guess this is something that people do in Canada as well as Europe. I did not know that until researching this. And the reason that Trump is proposing this is because there are a ton of Americans right now that have an interest rate below 4%. It looks like about 52% of Americans do, which is really high, but the average rate for mortgages right now is typically between 6 and 7%. So it's kind of hard for people to want to go move when they have a 2.7% rate and then they have to jump up to 6%. Even though their credit's really good, nothing's really changed there. It's just that the rates are a lot higher, and so people do not want to pay that much more in interest, as well as the fact that your monthly payment is a lot higher if you go from, 2.7% to a 6% interest rate, assuming the home value is the same. And even if the home value is less, the monthly payment could be around the same amount, so it wouldn't even be worth it, even if you were down downsizing in a lot of cases there. But the main reason that Trump is proposing this is because there are a lot of people that are locked into very low mortgages that are, 2.7, 3.5%, which is causing a ton of people to just stay in their exact same mortgage because nobody wants to move and increase that interest rate. And then the domino effect of this is that the housing supply is basically frozen because nobody really wants to buy a house because either one, you're a new home buyer and you don't want to get a 6 or 7% rate. Plus the barrier to entry is pretty high right now because home prices haven't really dropped or changed. So, it's pretty hard to afford a house right now. Or the second scenario is you already own a home, but you don't want to jump to a higher interest rate. So what's basically happening now is a ton of people just either can't afford a home or they don't want to move out of their current home. So the concept of portable mortgages basically unlocks inventory without people losing their low rate. So how a portable mortgage would work, like a hypothetical example, is let's pretend that you bought a home in 2021 and let's pretend your interest rate was 2.9%. But now you want to move in 2025 and let's say that the rates are now 6.5%. And so instead of refinancing into a higher rate, you take your 2.9% mortgage with you to the new home. And only the difference between your current home and the new home would get that new rate. So then who benefits the most from this? Well, home buyers with very low rates that want to move, that is the biggest winner in this scenario, as well as younger families that want to upgrade a house. Maybe they want to go from a $500,000 home to an $800,000 and get a little bit more room. Another type of person that could benefit from this is somebody who needs to relocate for work or people that just really are not wanting to lock in today's high rates, which I completely understand. And then also just the housing market as a whole would benefit from this because then there's more mobility and there's more people moving, which would then mean more supply. So those are some examples of who would benefit from this, but who would actually get hurt from this? Well, the first one is the banks. It's kind of like the opposite of the 50-year mortgage here because the banks would lose out on higher rate loans. If you owned a $400,000 house at 2.9% and then you moved into a $600,000 house, you would still have that 2.9% on the $400,000, but then the $600,000 would have the higher rate. And so the banks would be missing out on you just basically getting an entirely new loan at 6.5%. Instead, only a portion of your loan would be 6.5%. And to be honest, it would probably just be an entirely separate loan. So the banks would be hurt by this because they're losing out on higher rates for their loans. So banks definitely would see some downside from this, but also buyers that don't have an existing mortgage because they're still just stuck at current rates. So even if you bought a house in the last year or two and you're at that 6-something% rate, if you were to then move, you're not really getting any upside there because you're still locked in at kind of a higher rate. And so what could happen with this is that this actually might widen the inequality between a new home buyer versus existing homeowners because the existing home buyers could just keep their low rate and just keep rolling that over into any new house they buy compared to a new home buyer that is kind of stuck getting a 6 to 7% mortgage there. So that is definitely some downsides to that. So if we actually just look at the pros and cons of portable mortgages, the first pro is obviously that it keeps your low rate. So that is definitely pretty nice. The next thing is that it will make moving a lot less financially painful. I even saw an example of this with my previous job. My boss was moving from the city that we were living in to a completely different state that was a lot closer to his hometown. So him and his wife had to sell their home at a pretty low rate. I think they were at 3%. And then the new home he bought was at like 6%. And he was telling me he really hated that. And so it definitely makes moving a lot less financially painful because that monthly payment would probably not be that much higher. So that's pretty nice there. The other pro to this is this helps the current supply of homes unfreeze. It feels like there are a ton of homes right now that are just sitting on the market. They're not getting sold. And if more people can use portable mortgages to get into these homes, that could help. And then the final thing here is this would add predictability to long-term planning. And the reason that is the case is because you know that, hey, the mortgage that I have today, if it's 2.9% and let's say it's $200,000 of loan that's left over, if you know that we're always going to be able to roll this over into the next home, it's going to make long-term planning a lot easier because you're not stressing about getting that new rate because the new rate wouldn't be the entire loan. It would only be a portion of it. Or like I said before, probably its own loan in itself. So you'd have like two different loans on the same house. So it adds a level of predictability to long-term planning, but there's definitely some cons to portable mortgages here. The first con here is that home prices could also get pushed higher from this because, demand would go up because more people can now move. And like I said before, supply stays the same, demand goes up. That causes housing prices to go up. The next con of this is I feel like it would make understanding the loan structure for your house very confusing because like I said, you'd probably have two different loans. And I feel like Americans already don't understand money very well. And like I'm also an American saying this, but I just feel like the average American does not really understand debt very well. And so I feel like the average person may struggle to understand this concept because like I said, you could have two different loans on the exact same house or the structure of it would just be a little bit more complicated, which is kind of hard to keep up with. The next con of this is that this might actually require federal backing. And I don't know how realistic this is. I know they do it in Canada and Europe, but I just don't know if I could see this working out long term here. And so the federal government may have to get involved and start using their own money for, the portable mortgages. I'm not really sure what that looks like, but that is definitely something something that, I don't know. I'm not a fan of, getting the government involved in things. I feel like they're not efficient. And so I feel like when it comes to this type of thing, I'd rather them stay out of it. And the last con that I could see with this is it could create like rate classes where different homeowners have wildly different costs, because some people may have that 2.7% interest rate, whereas some people might be like more at 5 or 6%. So the monthly payments would just be a lot different. That kind of goes with like the inequality thing that I was talking about before. And so if we look at like the big picture here of the 50-year mortgage as well as the portable mortgage, okay, the 50-year mortgage, it's easier entry. The portable mortgage gives you easier mobility. And the effects of these two things is that you get more buyers. You have a lot less friction in the market. There's potential for higher prices, and there's better flexibility for families. So it could make home ownership easier, or it could make homes even more expensive long term. And remember, you're paying way more money in interest with that 50-year mortgage setup that we talked about multiple times in the first half of this video. So my final thoughts on this is I actually think the portable mortgage thing is interesting. I'm curious to see how that plays out. The 50-year mortgage, I do not think is a good idea. I hope that gets shot down very quickly. If you look at both of these examples, the goal here is to get people to be able to afford homes or be able to move into homes, but long term, I'm not sure if that would actually play out the way that they're expecting. At the end of the day, these policies are tools. They're not just magical solutions. Both are going to help some people and both are going to hurt some people. And the most important thing is to actually understand how they work before you form an opinion. And for most Americans, affordability is still the main issue. And if we do see a big increase in demand from either portable mortgages or a 50-year mortgage, again, it could just cause home prices to go back up quite a bit, which would then basically put us back to square one where nobody can afford a house. So not sure if it's going to work out long term, but that's just my prediction. At the end of the day, what matters most is your personal situation. Do not become house poor. Do not buy a house where that monthly payment is a very large percentage of your income. That is an absolute wealth killer. So that is it for me. I hope you guys enjoyed the video. If you did, drop a like down below, hit that subscribe button. I'll see you in the next one. Peace.